The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. This is our once every 3 weeks Investors Observer members only workshop. Welcome. This is our agenda for today. We're going to look at some charts, talk about what else is happening in the market, look at what sectors and industries are hot right now, and then the rest is questions. I got, I think, one question ahead of time. So we'll get to that. If you have questions at any point during the presentation today, just put them in the little GoToWebinar question box, and I will either get to them as we go or get to them at the end. One announcement before we get started. We did recently launch an Android app. We launched an iPhone app late in 2021, but the Android app is out now. You should be able to find it in the whatever Google calls their store, the Google Play Store or whatever it's called. Just search for Investors Observer and it should be there. All right. So, since we last spoke, the market has not gotten any better. Yeah, so I put 3-year charts and 1-year charts in addition. Yeah, so in addition to the usual 1 year, I've got 3-year charts for the major indices here. I think it's helpful to get a little extra context. We've pretty steadily held below this, or been below 4,000 a couple of times now. These are weekly candles. And yeah, I think today makes a new closing low since sometime back in early 2021. Certainly a new closing low for this stage of the market. I got this chart a little bit earlier in the day, but I think it actually ended up closing a little bit lower than here. Not lower than the intraday low, I don't think, but I think lower than this close. In any case, yeah, things seem to be just kind of going down. Yeah, I mean, the market today was sort of interesting. There wasn't really any attempts at a bounce intraday, which is something you see frequently, whereas today was pretty much just straight selling all across the board until it kind of at least stopped going down at the end of the day is maybe the best thing you can say about it. But yeah, we're sort of below all the points that would kind of normally be support or resistance here. There's not really as much to look at on the chart other than to say it keeps going down. The NASDAQ has fallen further. It also, I wanted to point this out, peaked earlier. So this is the 1 year on the S&P, and then this is the 1 year on the NASDAQ. You can see the NASDAQ peaked about the first week of November, whereas the S&P peaked the first week of this year. All right, so back to 3 years on the NASDAQ. We've obviously down for 2022 and have taken out all of 2021's gains as well. So that's, yeah. Tech stocks have been hit particularly hard. A lot harder than some of the other things, which we'll talk about sort of as we go in terms of why. But yeah, again, there's not really a lot of story to tell here other than just things keep going down. The Russell is a little bit more interesting to look at just because it was in this range for all of 2021 and didn't really go anywhere. So it's getting close to being back to the pre-pandemic high, which may serve as a point of support, a place where it could bounce, but yeah, we'll see. Also worth noting over here, the Russell actually peaked a week or so earlier than the NASDAQ when it, in 2021. And it has looked a little bit different the last couple of days here in terms of being, I don't know, less ugly maybe. I don't think it was down quite as much today as some of the other things, but it was certainly also down a lot. Yeah. All right. This, I think, is kind of interesting. This is the yield on 10-year treasuries. So just as a reminder, yields move opposite to prices. So if the yield is going up, prices are going down. It turns out that a couple weeks ago, earlier this month, in any case, the yield on the 10-year kind of hit a near-term peak and then started falling. It's interesting because all of this time stocks were going down and bonds, at least at the 10-year, tenor, were also falling, which suggests interest rates going up. But that seemed to hit. So the way to convert this to an actual yield is divide it by 10. So 3.167 is the sort of peak there. Today it was about, we'll call that 2.8. So if you think about the 10-year yield as the market's expectation for, say, the Federal Reserve Fed funds rate over the next 10 years, it's gone up quite a bit, which you would expect because the Fed says they're going to raise rates, and then maybe it got too high and it kind of peaked. I'm not sure anybody expects north of 3 to be the average rate over the next 10 years. And then it starts to pull back a little bit here. So this is something to keep an eye on. I think if it keeps going up, it will be interesting. We may get back to a cycle where people sell stocks and buy things like bonds. They've been buying things really on the short end of the curve, the 2-year and in, essentially. So yeah, that's kind of where we stand now, let's say. It's been interesting, and yeah, I think if yields keep going up, I would expect kind of stocks to keep falling. But I think if we get yields to start pulling back, stocks might stop going down quite so quickly. All right, moving on here. All right, the S&P 500 versus the equal weight. This is another thing that's kind of interesting. The classic cap-weighted index is in blue here. It has fallen certainly more than its equal weight counterpart, but they've been tracking relatively closely here recently. Really what this means is that a lot of the outperformance from the big tech stocks at the top of the index has been given back relative to the other names. It also means that sort of, everything is going down together in these more recent days. Correlations are getting high is another way of saying that. And the reason that's interesting is it suggests a little bit more maybe panic in the market, as opposed to sort of people picking and choosing things that are, seem to be priced too high to sell. And while panic in the market sounds bad, it tends to be the sort of thing that you get before a bottom. Right? So, I mean, if you think about it, you have a crash and then at some point there's a bottom and things come back. And so I'm not going to say panic is good, but I would say that this sort of high correlation suggests we may be reaching conditions where, things might start to turn around just because people are just selling everything as opposed to selling some things. All right, growth versus value. This tells a little bit different story than the one I just told you in terms of people selling everything. Certainly they're selling growth stocks, which is the blue line, a lot more than the value stocks, which is the red and green line here. Worth noting, since we talked earlier about things peaking, the S&P peaked the day the market opened for the year. The value stocks peaked as late as April. And again, then they started going down. So again, right, that shift between people selling all their stocks, or that shift from people selling stocks they think are too high to people selling all their stocks, has sort of come in here in the last couple of weeks. And that is, again, right, like a sign of something changing in the market, something different happening, that could sort of be pointing towards some kind of turnaround at some point. All right, this I think is interesting. Bitcoin and the NASDAQ. This is 180 days. But yeah, Bitcoin obviously ran up a lot higher. It peaked about the same time the NASDAQ did, that first or second week of November. But since then, they have traded pretty closely together. This is not, yeah, it's interesting because well, I suppose it's interesting for a couple of reasons. I think the Bitcoin fans would tell you that, Bitcoin is supposed to be a stable store of value and a lot of things like that, unconnected to the regular financial system. But Bitcoin has lost an awful lot of value basically in the same time that the tech stocks have lost a lot of value. And everybody says the tech stocks have lost a lot of value because the Fed is tightening. But why would the Fed tightening affect, a financial system that's independent of the Fed? The reason for that generally is a lot of people have gotten into Bitcoin, and they don't all share the stable sort of value theory. A lot of people got into Bitcoin because it was a thing that was going up at a time when, the number of things that were going up was basically tech stocks and some cryptocurrencies. And so now those institutional investors are looking at losses places, and, they either have redemptions they have to meet, or, some other thing, in which case you end up having to sell. Also, people, tend to move down the risk curve when interest rates rise. So your more speculative assets, which it turns out Bitcoin probably falls in that bucket more than the stable store of value bucket, tend to lose ground in that kind of thing. It correlates. I know it did a little bit different today in terms of what Bitcoin did, as opposed to what the NASDAQ did today. Bitcoin actually rose a little bit in the afternoon, as did some of the other cryptocurrencies. But yeah, the correlation there has been pretty high for a while. And it's really about, tighter monetary conditions just sort of mean people aren't interested in speculating on some of the riskier things that they had speculated on previously. All right, this is not the best way to display this information probably, but I did want to look at some electric car stocks. It seems strange, perhaps, that, at a time when gas prices are at record highs, the electric car stocks are all getting beaten up. But I just kind of wanted to look at valuations for some automakers generally. And we can talk about, sort of why some of the electric car stocks are not doing well. So GM has a PE ratio of 6.5, which historically 15 has been considered to be fair value. Now, GM's a big industrial company. They're facing a transition. They have been dealing with some parts shortages coming out of the pandemic. So I'm not necessarily saying the price should be more than twice what it is currently, which would get that PE ratio closer to 15. But, okay, you've got GM, which is an established automaker. They sell millions of cars every year. It's a cash generating business. They're trading at $6.50, 6.5 times earnings. Their revenue per share is $86.51. Ford over here has a PE ratio of 4.5. Their sales per share are $33.80. The stock price is lower, so that sales per share doesn't seem too far out of whack. Toyota right here, PE ratio of 11. Price to sales is 183.42. Toyota stock price is considerably higher than GM and Ford. So again, that makes some amount of sense. Tesla's PE ratio is 117, which again, Tesla's growing, which typically justifies a higher PE ratio. Whether it justifies a 7 times what is considered to be fair value PE ratio is, I guess, up for discussion. But yeah, so their price to sales is 47.67. Remember, Tesla is hundreds of dollars compared to GM at like something in the 40s. Lucid has no PE ratio because they've never turned a profit, and they make 4 cents in revenue per share. Ride, which is Lordstown Motors, never profitable, no revenue. Nikola, never profitable, no revenue, or at least less than a penny per share. Workhorse, never profitable, these should all be price per share, not price to sales. I'm not sure exactly how that happened. But yeah, a penny of revenue per share. NIO, one of the Chinese automakers, never profitable, $2 per share. Fisker, never profitable, no revenue per share. RIVN, never profitable, very little revenue per share. So it makes sense sort of, I think, objectively in a vacuum that, gas prices are super high, maybe you should look at electric cars. But the thing is, these stocks got bid up so much when everything else was going up. They were some of the big winners from the pandemic. And yeah, people, it turns out, in this kind of market would rather have a company that has a history of making money, which typically means profitability. But in these cases, we're talking about companies that don't really even have a history of, making a product for sale. And so that's essentially why the electric car stocks are all not doing well. It's because they all have very high share prices to begin with. All right. Moving on. All right. What else is going on? Interest rates, inflation. The Federal Reserve is still, pretty much driving the market bus here. The Fed seems to be getting more aggressive with what's called forward guidance, which is a fancy way of saying more aggressive with what they say they might do in the future. Powell made some remarks yesterday about, the pace of rate hikes and the number of rate hikes. 50 basis points seems to be more than likely for the next couple of meetings. There's lots of weird outside effects potentially keeping inflation elevated, right? Crop shortages are not going to be affected by interest rates in any meaningful way. But yeah, we'll see. I think the Fed would prefer to use the forward guidance tool because it's easier to sort of threaten higher interest rates and see things tighten up a little bit in the market than it is to actually raise and lower rates. And probably, is just a little bit sort of easier on the economy's financial plumbing to do it that way. But they do seem pretty willing to actually go ahead and raise rates if necessary. Earnings have been kind of mixed so far. The sort of earnings beats and misses tend to be less important than the guidance, just because, what you did last quarter is in the past and people buy stocks for future performance. Companies facing increasing costs. I haven't really heard anybody say it yet, but you have seen, I guess, Target was the one today, faced some margin compression. Lots of tech companies are seeing slowing growth after the pandemic. Netflix sort of reported relatively early and kind of set the tone for the earnings season in terms of doing okay on revenue, but their outlook was pretty bad in terms of what they expect going forward, and they didn't add as many subscribers as expected. But a lot of that is because when the pandemic hit and everybody had to stay home, tons and tons of people signed up for Netflix, but now people have watched whatever they wanted to watch from Netflix, or they just have other things they can do. There have been several other streaming services that launched since that started. Disney Plus, I think Peacock is NBC's streaming service. There's more competition now than there was also. On the valuation front, the S&P 500 forward PE ratio is like 16.6, which is below recent averages, but still above the longer-term average, which, like I said, 15 is typically being considered to be about fair value. The actual dollar value of projected earnings is still at a record high for the next quarter and year. We're not really looking at any kind of earnings recession, even though people are talking about recession more often. The big thing from the chairman of Goldman Sachs over the weekend was, a 30% chance, which is, a 60% chance of not recession, or I guess a 70% chance of not recession if you only said 30. But yeah, earnings don't look bad. It's really the sort of growth outlook. And with the exception of a few things like Netflix, it's really not an issue of things shrinking. It's more an issue of things growing more slowly than previously been expected, which is still, expansionary in economic terms. And yeah, finally, Russia, Ukraine, and the situation in China are all still wild cards. The China one I think is most interesting. Just like a report came out yesterday that in the area that encompasses Shanghai, there were 0 cars sold in April, which is, I don't remember exactly how many millions of people live there, but it's a lot of people live there, and none of them were able to buy a car. That's sort of not great. I think sort of longer term, this probably does more to push people out of China to diversify their supply chains and things like that. In the short term, it just kind of means more pain for everybody in the sense of stuff's going to be harder to get. Anything that has a leg of the supply chain that passes through China potentially is going to be harder to get because they're just doing sort of rolling shutdowns to try to stick to that zero COVID policy. All right, the stuff that is doing well in the market right now, energy is doing pretty well, continues to. Thermal coal, oil and gas drilling, oil and gas E&P, the same as it's been for a couple of these sessions now. Utilities, again, in the second spot, largely the same. I think the regulated electric and regulated gas flipped this time through. That may be something as simple as it's warm everywhere now, and so people aren't using like the gas company probably just makes less in the summer because of gas is used for heating and not for cooling. Real estate, residential has kind of lagged for a while, but is near the top now. I think that's largely an interest rate story in terms of why those are doing well. Also, people have demand for housing and things like that. It's interesting to see retail pop back up here. I think the death of retail from the pandemic was perhaps greatly exaggerated. Financial services. The shell companies is kind of a weird one. I wouldn't have expected that, but I think some of that is there's a few SPACs that had been beaten up and maybe recently announced deals once they were getting close to their SPAC thing expiring. Also, some of them were trading for less than the $10 price, which SPAC is, until it completes a deal, basically a bucket that has $10 in it. And so for it to trade below $10, it's not great for the people running the SPAC, but there is an out there where when that you can, when it comes time for shareholders to vote on the deal, they can either stay in the SPAC at whatever the price is and own shares of the company that the SPAC merges with, or they can get their $10 back. So there's not a ton of reason for those to trade below $10. And then regional banks and the bigger, more diversified banks. That's again largely an interest rate story. And then basic materials moved from, I think, third to fifth, and it's coking coal, agricultural inputs, and steel, with the exception of the coal. Probably all things that have been in the news recently, but coking coal is actually an input in the steel making process, so perhaps that's not too surprising. And remember, this is U.S. stocks, so while there are a lot of global companies that are based in the U.S., especially with things like steel, there tends to be a little bit more onshore production captured here than sort of on a global level. So taking things like parts of China and some of Russia, and even in some production in Europe has been shut down because energy costs in Europe are particularly high right now. So that sort of helps out the U.S. producers. All right, you can find this information. These are all how the sectors rank based on our short-term technical score, which looks at how things are trading in the last 20 days, which is basically the last month. By going to stocks and then sector and industry, you can click on the sector to see how the components are doing, and then also the top stocks there, and you can filter through any of our 7 scores here. Yeah. All right. Another thing I wanted to talk about while we're on the website was another way to find stocks that are going up, right? Like obviously those sectors and industries are doing pretty well. But I said earlier, I saved it, cool. I said earlier that things, companies with a history of profitability tend to be doing better. So I set up the screener here. I just put in a PEG ratio of 0.01, which effectively just means make sure there's a number in there, which means that earnings are positive and growing, and a PE ratio of 0.01, which again, just basically any sort of positive earnings number. And if you do that, you can sort that list by, say, short-term technical score if you want to find the things that are going up more recently. You could sort it by the overall score if you wanted to find things that have a little bit, maybe healthier look across the board. But there's a lot of big companies on here that don't look bad. They're not necessarily in the sort of sexier parts of the market in terms of, biotech or tech or, some of those sorts of things. I don't think there's any lithium companies on this first page here. It's pretty boring stuff like insurance, some basic material stuff. These are some kind of industrial thing. I don't remember exactly what this company does. Yeah, so there are a few tech companies on here, but digital transformation IT services is not necessarily an exciting part of the. Yeah, okay, so they're in the industrial sector because they're a staffing company, effectively. This is a stock that's up year to date. This one in particular doesn't pay a dividend, but it has a PE ratio that's relatively in line with the overall market, and like I said, is up on the year, which the overall market and an awful lot of stocks are not. So that's another way you can use the website to try to find things that aren't getting killed every day. Is look at that. Here's another one of those agricultural inputs stocks. Bunge is another fertilizer name. But yeah, all right. I did want to show that off. Okay. All right. I said we got a question. So Marcine had a question about the liquid natural gas business and Europe. And she mentioned specifically Occidental, Cheniere Energy, and Exxon. And yeah, winter is only 4 months away. So, presumably people are trying to lock in gas supplies. But yeah, of the stocks listed, Cheniere Energy is the only one that I think really is if you want to make a strong natural gas export play. I mean, Exxon is in that business, but Exxon is also in every other corner of the energy market. So I'm not sure Exxon is really a bet on anything other than maybe, global prices for, oil and natural gas. Occidental is a little bit more specialized. They do, sell some natural gas into the LNG channel, but a lot of it is, a lot of their revenue also comes from more traditional petroleum drilling. So yeah, Cheniere Energy is the only one that's really a sort of pure natural gas export play here. And Cheniere is a company that operates basically a couple of big facilities that buy natural gas and turn it into liquid and load it onto ships, and then it gets exported. And so functionally, that ends up being a bet on the difference in price between natural gas in the United States and natural gas in Europe. Turns out that right now the price of natural gas in Europe is real high because they are trying as hard as they can to not buy gas from Russia, and that ends up being good for the U.S. I think based on what I've read, the limiting factor there really seems to be that a lot of the existing capacity, like I said, Cheniere operates basically 2 facilities. There aren't more than a handful of these sort of big terminals that turn natural gas into liquefied natural gas. There are more than a handful of them in the United States, and a lot of their capacity is sort of contracted and pre-sold to. It's mostly been places in Asia historically, but I expect that they may sell everything they can to Europe at probably a pretty high price. Tellurian, ticker symbol TEL, is another LNG player. Really, I mean, anybody in the natural gas business should probably get some bump from exports to Europe, just because, like I said, the price onshore in the US tends to be different and a little bit lower than the price onshore in Europe. And the more this capacity tends to grow, which I know Cheniere is working on increasing their capacity all the time, that just means more gets exported to places where the price is higher, which should close that gap a little bit. Yeah, shipping ends up being kind of weird because those ships are very expensive. And so what happens is you borrow a bunch of money when the price is real high, the price for shipping, that is real high. And then a lot of times what happens is the price falls because a whole bunch of people borrowed a bunch of money and bought a bunch of ships, and a bunch of capacity comes online all at once, and then the price for shipping drops, and then some of those some of those shipping companies end up usually going bankrupt. The ship stays sailing around. It's just the stockholders of the shipping company get wiped out, and it goes to basically the people who loan them the money to build the ship. So I tend to kind of stay away from those stocks just for that. But I think if exporting natural gas to Europe is a thing you want to bet on, I think something like Cheniere or Tellurian or some of the other onshore gas players is probably the way to do that more than the shipping stocks. All right, let's see what else we have for questions here. Is it worth buying good tech stocks? Apple, Tesla, Google, Microsoft, now that the stocks apparently are cheap. So yeah, I guess for some value of cheap, that might be true. All right, we just talked about Tesla having a price to earnings ratio of 117, which yeah, it's cheaper than it was. Microsoft is closer to 30. Google Alphabet is at 20. Apple is at 24.3. So there's, yeah, two different neighborhoods there in terms of Tesla at 117 and then Apple, Google, Microsoft at somewhere in the 20s. I think that's very different. If you like a stock and the price goes down by 30%, you probably should like it more, right? Like if you liked it at whatever it was trading to start the year and thought it was a good company, certainly, knock 30% off and it gets more attractive. That's not to say that those are good stocks to buy because you can flip them in the next couple of weeks for a profit. But I think that is a good way to think about things in terms of big stable companies that have certainly have more attractive valuations now than they did previously. Let's see. Eric says, what industries will be affected the least if this continues? So Eric, you say if this continues to follow the 2008 trajectory, which I don't. Yeah, I mean, in the sense of the stock market is going down, I guess we're following that trajectory. But we just talked about banks are performing relatively well here. Banks were obviously leading the way down previously. What we had in 2008 was essentially a financial crisis, right? A whole bunch of assets were essentially mispriced. And then a bunch of people who thought they had assets that were worth one thing found out that they were worth a very different thing. And that had the effect of sort of freezing the economy in the sense of, right, like nobody knew, yeah, right, from a banking standpoint, nobody knew which other banks were liquid, and so nobody wanted to trade with anybody else. We're not in that sort of situation right now. What's happening right now is essentially some things that had very high valuations are seeing their valuations get cut for a bunch of reasons. It's a tightening of financial conditions, but it's not a freezing of financial conditions. Banks have plenty of money to lend if they can find somebody to lend it to at an attractive rate. Right, it's a very different situation than 2008. Unemployment is low and hasn't really shown many signs of ticking up. And even if it did tick up, it's still lower than it was, before the peak, or before the crash in 2007, 2008. So I don't, I don't think we're on a 2008 trajectory other than just sort of the basic, very high level. Well, stocks are going down. And they also went down in 2008 kind of level, kind of thing. But yeah, I mean, we also just talked about a list of things that are doing pretty well, right? Energy is doing pretty well. Some of those financial services things tend to do well when interest rates are rising. Consumer staples are also, I mean, some of them got beat up today, but you can look at, some of the things in the food industry, let's say. General Mills, not great. But, oh, this is the wrong ticker, and that's why. Yeah, it went down a lot today. So it's at, well, roughly break even for the year is still considerably better than the overall market. But yeah, some of this packaged food stuff, these are some of the things that have been performing pretty well. Your basic necessities, right? Things that, right? Bills that people won't cancel. So people will cancel Netflix, but they probably won't cancel, breakfast, lunch, and dinner, or gas, or rent, or things like that. All right, so William says, you think American lithium stocks will go up? Yeah, that's an interesting question. Lithium is obviously a big piece of batteries, but a lot of those companies are kind of in the same bin as the electric car stocks, in the sense of it seems like a thing that should be going up right now, but it's not. And if you look at why is that, some of those companies have plans to open a lithium mine is about as far as they've gotten. It's a pretty speculative sort of thing, right? Like, I can have a lot of plans. It doesn't mean I'm going to do anything, and it certainly doesn't mean I have a track record at doing that thing. So yeah, the lithium stocks are a place where I'll just say you really need to do your homework. I don't want to put them all in that bucket necessarily, because I think there are probably some that are better than others, but I wouldn't be able to tell you which one it is. Is there a reason you don't use bull call spreads? I think the credit spreads are easier because you don't have to close them, right? You don't have to worry about exercise assignment or any sort of dividend risk. I mean, functionally, most of the time, it's exactly the same trade. In terms of the dollars and cents across the board, we have done bull call spreads in the past, but people, we get more people asking for credit spreads than we do debit spreads, and I kind of prefer the credit spreads for the reasons I just mentioned. Uday, you have a couple of questions here, but you just said, is this a good buy? And I don't know what this is. All right, so Garth has a question about the portfolio trades. Yeah, I mean, we've been light on portfolio trades because, yeah, the market's been terrible. And I think it's easy to say, like, oh, hey, you should do bearish trades when the market is going down. But if you look, the market tends to go down and then sort of unpredictably come roaring back. So we're much happier, I think, picking our spots here. And trying not to lose money than trying to be a hero or do something more risky. I think generally for the same amount at risk and whatever else, the stock market has an upward bias. And so even though I don't know if it's going to go up tomorrow, my general sense is that over the long term it's going to go up more than it's going to go down. So we kind of would prefer to have long positions. By that I mean bets that things will go up than things will go down, just because things tend to be more predictable to that side. Yeah. All right. So Uday's question is about Apple. And yeah, so Apple, it's interesting that Apple's fundamental score is 42. I think a lot of that comes in because it's peg ratio is a little high in the sense of you would like to see something closer to 1. Obviously something close to 2 is not as high as it could be, but it's a little high for a established consumer electronics company. And it's also fallen a lot recently. Again, like, I don't think Apple is going anywhere. If you're investing for the long term, there's an awful lot of stocks, including probably Apple, that are on sale right now. Like if you're want to do things for the short term. I don't know. Yeah, I don't know what that looks like right now. I just talked about not making portfolio trades. We have one on CF Industries, which is essentially a fertilizer company. I feel good about stuff like that. We've also done a couple things on some energy names and things like that. Those work okay for short-term trades, but if you're investing for the long term, there's an awful lot of big companies that are on sale right now, and Apple's probably one of them. Which is not to say it might not be cheaper in a couple of weeks, but it might, yeah. But 5 years from now, I don't think Apple will necessarily be much smaller than it is today. Barring something crazy that I haven't thought of happening. All right, Melinda wants to know about Wells Fargo. Banks are doing pretty well right now. Wells Fargo is kind of an interesting case because they've had a lot of sort of legal troubles over the last several years that I think may have pushed the stock down further. And then some others, like if you look at Wells Fargo, they've got a PE of 9.1, whereas right in line with JP Morgan. So it may be the case that okay. So it seems like Wells Fargo has, maybe not been undervalued, based on those things. So yeah, I think all the bank stocks are, they pay dividends. I don't, I don't think buying a few bank stocks is going to make anybody, incredibly rich in the sense of, it's not a tech company that's going to do super awesome or whatever. It's unlikely to triple in the next 5 years, but yeah, it's a giant bank. It makes money. It pays a dividend. It's bank stocks are not a terrible place to stick money. Just generally, and yeah, rising rate environment with a strong economy should be relatively good for it. I don't have the quote. So the question is, do I think it'll ever reach 52? I don't have a price target for it. It seems like it was at 52 as recently as last month. So certainly not out of the question. It's been above or around 52 some number of times over the last 5 years. So yeah, it probably will at some point, but I don't know when. In the same way that I don't know when the market's going to turn around. All right, so Skylar has a question about BVXV. To be specific, the question is, I'm holding a day trade down 30% from December. Don't mind the chart, but curious about my thoughts. Yeah, all the biotechs have been beaten up pretty recently. Yeah, so they're in the vaccine space, so they got a huge bump when COVID hit and then fell off a cliff. It looks like shortly before the vaccines were approved. And they don't mention attempting a COVID vaccine here, which is kind of interesting. But yeah, the best answer I can give you is I don't know. Right, phase 1 and 2 trials are relatively early. But the thing that I say about all these biotech companies is what they're essentially doing is very expensive science experiments. And so they burn a lot of cash and hope that they can get a product to sell. This company doesn't mention having a product to sell, which is not to say it won't ever have a product to sell, just it doesn't currently have a product. And so, yeah, I mean, if you like it and believe in the company, it might come back, but I'm unable to predict how the science experiments will turn out, which is, why I personally don't really do much in that space, just because I don't feel like I understand it or have any handle on what's going on there. All right, we did record this session. You can find all of these. It'll get posted here in the featured section tomorrow. You'll also get an email once it goes up. And then you can should be able to find it in the personal finance section. There was a question earlier about the last one, which was like April the 27th. I'm not entirely certain why it doesn't show up here, but I'll try to figure that out and get it up. And then, yeah, you can scroll back through and find a bunch of the older workshops here if you are interested. All right. That said, there's a couple minutes left if anybody has a late question. But yeah, other than that, thank you for coming. Thank you for subscribing to Investors Observer, and I will talk to you again in probably about 3 weeks.